All right, welcome everyone. My name is Matt Firestone. I am president of Firestone Consulting Group, and this is our September edition of our webinar series. And as you can see on the screen, this month we are talking about financial reports and really looking at three reports in particular that you should be monitoring to really get a good picture of the health of your operations. Real quick before we get into the meat and potatoes of our presentation, just real quick, for those of you that are new to our webinar series, we do these webinars the last Wednesday of every month on a wide variety of topics ranging from estimating to employee engagement to the financial health of our operations. But at Firestone Consulting Group, we work with the leaders and owners of construction firms around the country to help them build businesses for the lifestyle that they desire. And we do this through leveraging their people and developing a well-oiled system to operate their business. Our methods are based on real-world experience of actually running and growing contracting businesses, and we use those experiences to help our clients grow. With years of hands-on experiences, our team of advisors and consultants will help you define your goals, develop a plan to achieve them, and help you to implement the plan, and most importantly, be right there with you to celebrate your successes. Today's webinar is going to be a little bit different than some of the previous webinars that you may have attended. I'd like to welcome our guest today, Jacob Malozzik from ARC Financial. And as you can see, ARC Financial is an expert in accounting system and processes, and Jacob and his team work with business leaders to gain clarity of the financial health of their operations. They do this by identifying 3 to 4 key indicators that will provide the most value in decision making, and then help you to develop a specific plan of action of how to use that information. In addition to the accounting system and process consulting, ARC Financial offers other services to their clients such as full service payroll and bookkeeping services. If you would like more information on ARC Financial, you can visit them online at arcfinancialservices.com. And with that, I'm going to welcome Jacob onto our call, and I'm actually going to flip over and he's going to be sharing his screen for part of the presentation. So welcome, Jacob.
Hey, thank you so very much. Again, my name is Jacob Malozzik with ARC Financial. And what I wanted to do for us today was go through and kind of talk about what our financials look like inside of our business. And I know that, we've got a number of people on this call, and we might have different roles, responsibilities inside of the companies that are represented here today. But kind of one of those first things that we find where some people, as they are transitioning from one role in a company to another role in a company, is we might get asked just the basic question of, hey, I want to see your financials, or hey, let's dig into your financials, whether that's coming from a banker or whether that's coming from, a business coach or somebody that's walking alongside your business. And we might just have to ask ourselves, well, what does that really mean, right? So you want to see my financials, what does that really mean? Well, in all reality, from kind of this academic point of view, our financials are going to be represented in 3 separate reports. And so the first report that we talk about when we talk about our financials is our income statement. And we're probably familiar with this report, right? Because most people at some point in their career are going to be exposed to an income statement. Now, this report, however, does go by a whole bunch of different names. And so we might hear this report called a profit and loss report, a P&L report, statement of financial activities, or an income statement. And essentially, those all mean the exact same thing. We're just painting it with a different brush. And however, it's important for us to understand what this report does for us. And so when we start talking about our profit and loss report, income statement, what that report does inside of our business is it tells us over a period of time, whether that's last month, last quarter, last year, What was my income that came into the company? And what were my expenses going out? I know that sounds just so incredibly basic, but just top line, when we hear that term top line, what's our income coming into the company? And then, what are all of our expenses going out? And then we get our bottom line, right? So what's our net income? And as sophisticated as we want to make our business sound or act, or the highest price consultants that we can bring in to help us with our business, there's one fundamental fact that has to just rise above all else. And that is that for every dollar coming in, we have to have less than $1 going out if we're going to be what's called a growing concern. If we're going to be in business for any period of time, obviously that's going to have to be the case. And so what I want to do during this webinar, firstly, is I'm going to break apart that profit and loss report. Because a lot of times, as basic as that report is, just telling us what's coming in, what's going out, there's different ways that we can analyze that report to help us begin to tell the story of what's going on inside of your four walls, what's going on inside of your business. And that report's going to help us determine that. Now, when we talk about our financials, and this first financial, the income statement or profit and loss report, when we talk about these financials, I always give them a nickname, right? So, in all reality, my profit and loss report is my management effectiveness report, right? So what that means is that it is going to tell me on a piece of paper, black and white, how effectively are we managing this organization? So that's the first report. And we're going to spend the most time on that, just kind of giving you some different ways that we can look at that report. The second report that we would talk about in our financials would be our balance sheet. And so when we talk about our balance sheet, this report works just a little bit differently. Our balance sheet tells us at a moment in time, at a snapshot in time, what were all the assets of the company? What were the liabilities? And then what was our equity inside this company? Now, we find when we're consulting with a lot of companies that, yeah, they're digging into their income statement all the time, but perhaps we're not digging into that balance sheet report enough. We probably heard the term balance sheet, but have we really kind of dug into it to understand what that report is telling us? Again, it tells us at a snapshot in time, what was our assets for the company, how much money do we owe other people, and then what was our equity? What a lot of times we don't always recognize or fully understand is that when we're talking about that report and we talk about the equity, sometimes it can just be confusing when we're looking at that inside of a business. But what we have to keep in mind is that equity inside of our business is the exact same thing when we talk about equity inside of our house, right? So how this report breaks down is the same way that you would use it to determine the equity in your house. What is that asset of your home worth? How much do you owe the bank on your mortgage for that? And then how much of that home do you own? That's your equity. Well, as we are looking at a business, it works exactly the same way, just on a much, much larger scale. And with that report, that balance sheet report, the nickname that I would give that report oftentimes is our cheerleader report. And the reason I would call that our cheerleader report is because if you are in a business or organization that is either kind of in a startup phase, or maybe we're in a rapid growth phase inside of our business or organization, there's typically something that we don't have a lot of just laying around. And that's just liquidity. We usually don't have a lot of cash laying around inside of our business. And so if you're in that entrepreneurial role, or you're in that leadership role, or that management role, and all we're doing is we're focused on that cash position in the business, which obviously is incredibly important, it's not telling us the whole story of what's going on inside of your business, right? What's going on inside of your four walls. It's not always the clearest picture, right? Because if our business is growing really, really rapidly, oftentimes our receivables are growing really, really rapidly as well. And so a lot of times we're not going to have that free cash flow because we're essentially financing our customers. Well, the reason I call our balance sheet the cheerleader report is because if, your business is in a growth phase and we're struggling with, some tighter liquidity and we're having to come up with solutions for that, that balance sheet, what I call the cheerleader report, is going to give us that fight to go on another day. And again, we'll typically see that in startup businesses or businesses that are going through rapid growth, where focusing on that balance sheet will be absolutely critical. The third report we're going to talk about today is our statement of cash flows. And most businesses don't talk about this report as much. But in all reality, our statement of cash flows, again, it allows us to look at our company in an incredibly unique way. And what it does for us is, let's say, for example, we're looking at an income statement. And that income statement says, hey, whatever period we're looking at that. If we're looking at that last quarter, last month, last year, it says that you made $100,000. And when I'm looking at that, it's hard for me in my mind to believe that figure on there, because, when we're thinking about it, it should be that if I made $100,000, I would have an additional $100,000 sitting in my bank account. Well, it doesn't always work that way. And so what the statement of cash flows does is it reconciles your net income to the different things that have happened to your cash, and it reconciles that to your beginning and ending cash position. And what that allows us to do is to kind of determine inside of our business where the cash is going. So for example, we have many things that consume cash that would never show up on our income statement. For example, in what I just talked about, if we're growing really, really rapidly and my accounts receivable was growing, you've actually taken your cash and put it into your customers' pockets. So you don't yet have that cash to reflect inside of your bank account. If you're paying off debt, you're taking cash from net income and you're paying off your lenders or you're paying off your vendors. And, perhaps as a shareholder, you'll take a distribution out of the company, and that will reconcile where that cash goes. So kind of the unconventional nickname I'll give to that report is maybe like our WTF report, right? So, because as a business owner or a business leader, you're going to ask yourself sometime, hey, where the heck did all the cash go? And this report will help us dive in and understand where that goes. So today, for our example, when I'm going through financials, I'm sure that a lot of you use different accounting software, so on and so forth. I've just got QuickBooks loaded up on here, and we're going to kind of dig through financials on QuickBooks. This lesson is not a QuickBooks lesson by any means whatsoever. This is whatever system you're using, how we're going to pull these reports and what lens we're going to start to look at these reports with. But before we get started, we're going to do just kind of a little bit of interaction with you, and we're going to do some polls. And so the first poll that we're going to put up here on your screen for you to have you answer is, as we're starting this lesson today, how would you rate your own financial literacy and being able to understand financials? And so we're going to put that poll up there, and on a scale of 1 to 5, starting with 1, like, hey, what is financial literacy, to 5, hey, if I needed to, I could step in and I could be the CFO of my company or organization. So if you could go ahead and fill that in, we're going to give it just a couple of seconds for you to click on your screen.
So Jacob, real quick, while everybody's responding to the survey here, or the poll, I mean, what I'm hearing from you with these 3 reports is there's great information in each individual report, but there's even more value if we start looking at them and using them together. Would that be a fair statement?
Absolutely, absolutely. And I think, Matt, to your point, is that sometimes we will look at these reports and yeah, they tell us a story, but what I hope to take us through today is how do we start breaking apart these reports individually, and then kind of combined, how is that going to help us make decisions inside of our business or our organization?
Great. Well, I'm going to go ahead and end the poll here. We had about 2/3 of the group respond. I will go ahead and share those results, and hopefully everybody can see that on their screen. But definitely the bulk of the group has a fairly good understanding of or rate themselves above average as far as it comes to financial literacy. The bulk of the group here, just over half or maybe a little bit more, are in that 3 to 4 range. Have a few people that have rated themselves at a 5, and a couple that have rated themselves below a 3. So I think, I guess how I would interpret that is most of the people have a pretty good understanding, at least are familiar with it, but could definitely use some additional information of how to best use that information in their decision making.
That's awesome. That's awesome. And so, my goal in doing this is not to talk under or over anybody, just to give you some ideas, or maybe even for some of you, this just might be kind of a refresher of here's how I'm going to stage this when I pull my financials at the end of the month. The next question that we're just going to do before we get started here, and then we'll have kind of one last question towards the end of this, is, it's kind of what accounting software does your company use? Now, I understand in your accounting cycles that there might be a number of different pieces of software that you use, but do any of these pieces of software fit into your company or organization? And so, Sage, QuickBooks, NetSuite, there might be another piece of software there. Yeah, so if you can we'll kind of go through that real quickly, have you answer that question, and then we're going to kind of get started in building these reports.
We'll give about 5 more seconds here. It looks like a few more people are clicking on that, but all right, we'll go ahead and close this poll, and I'll share these results here. But definitely can see that just over half of the group is using QuickBooks, few using Sage, and then the next largest group is other. So, and if any of you care to share via the chat what some of the other accounting software platforms that you are using, we'd love to see that information as well.
Awesome, awesome. Well, that's probably how I would have predicted those results to come out here. So what I want to do here is I'm just going to start walking us through that income statement and what that looks like. And so, obviously how you get there is going to be different in every piece of software that you're using. But essentially, I'm just using some kind of sample company data here that we're looking at. And whenever I look at an income statement, there's always 2 things that I'm going to start with when I'm looking at that income statement. And that first thing that I'm going to start with is what date range am I looking, what date range, what lens do I want to start looking at this at? And so when I do that, obviously I'm going to adjust this date range here. I'm kind of refresh this so that way my income statement comes up here. Now, this is just as I explained it, right? So I've got between these dates here, what was my total income? What was my cost of goods sold in order to derive my gross profit number? So obviously in your world, cost of goods sold is if we're a contractor, those material costs, direct labor, all of that stuff is going to go into your cost of goods sold. Essentially what that means is what were my means of production to get to that end result. Those are going to be your cost of goods sold. And then we have essentially all of our overhead expenses coming down here until we come up with a net income number. Now, what we see is kind of like historically what happens is this is what an average profit and loss might look like that a business would have produced for them at the end of the month. However, we always want to look at this report with a few different lenses. And so what those lenses would be is, so the second thing that I always look at when I'm pulling up this report is what basis am I running this on? Am I running this on an accrual basis, which is simply means, hey, this represents everything I invoiced out during this period of time, whether my customers have paid me or not. And it also represents all the expenses I've incurred during this period of time, whether I've actually paid those bills or not. In construction, we're typically going to always look at our books through that lens, through the accrual basis lens. You know, we also have a cash basis, which would just represent, you know, for my income, here's all the income I've received, and here's all the expenses that I've actually paid out. So just cash in, cash out. Now, when we start to look at this report, one important thing, the first way that I'm going to look at this is by doing something that I call a vertical analysis. In order to do a vertical analysis, whether you're in QuickBooks or any other piece of software, essentially what I'm going to do is I'm going to add a sub-column inside this report to determine each different line item on this report, what that represents as a percentage of income. And so when I customize my report here, you can see that that added another column here. And what we find as operators, those who operate at a really, really high level, we're usually not actually looking at the dollar figures over here. We're looking at this percentage of income figure over here. And let me just give you a high level what this represents. So if I look at my advertising right here, that says that it's 4.8%. And so what that means is for every dollar that's coming into my business, I'm spending 4.8 cents on that particular line item. Okay, so that's just boil it down to the most simple way that we can look at this. Every dollar coming in, how much am I spending on this particular line item? And what we find is that, you know, really successful business owners will have 3 to 4 of these different metrics or these different line items that they will manage to the nth degree. They will just know what that needs to be inside of their organization. And, you know, to kind of break this down, it's pretty simple in the construction business what we're going to focus on. So one of those line items is always going to be job materials. And, you know, this is going to be different across different trades. But, you know, let's say that, for example, we know that our job materials always have to be 32% of our income in order for our model to work for us. You know, so materials is always going to be one of those metrics that we're going to know as a percentage of income what that needs to be. The second one is that inside of your organization, if you have anybody who's breathing that you cut a paycheck to, those labor expenses are going to be a part of this. As your company grows, right? So you're probably going to have 2 different categories of labor costs that you're going to look at. You're going to look at your direct payroll costs, what that is as a percentage of income, and then you're probably going to have some overhead labor as well. So that admin staff, you know, for every dollar coming in, how many cents are we spending on our administrative staff? And then, you know, we'll typically tell a business, go ahead and just pick another metric that you're going to follow inside of your business to try to maximize your efficiency in running your organization. So a story that I like to tell is I was working with a company in some small town in the middle of Iowa. And I know this doesn't relate to the construction industry, but what had happened was we rolled into town late that night. There was a restaurant. Me and one of my associates went into that restaurant, and there was a high school cashier there behind, you know, at the point of sale system, and they rang us up. And as we were walking away from the cash register, she turned, and this was a high school cashier. She turned and was talking to somebody back in the kitchen and said, "Hey, with that sale, we are now at 17% labor costs for the day." And for me, that was just like this aha moment that there was this restaurant in some small town in Iowa to where everybody inside that organization knew what that goal was. And so that's kind of my challenge for you is that inside your organization, does everybody know where our goal is for material costs? And do we know what our goal is for material costs as a percentage of income? And are we able to communicate that in a way to our entire team that they understand where we're at and we're able to track that? Because once we get to that level, and we can start to teach our people, amazing things will happen, and we'll get to see those things become more and more under control. And so how we teach business owners to start to examine this, and by the way, if you don't know what your material cost should be, go look and see what it was historically. Or, there's trade associations that you can reach out to say, hey, for a contracting firm that's my size, on average, what is the percentage of income on material costs, or on direct labor, or on overhead labor, whatever that might be. You can kind of set a metric for yourself. And then what we do is every month when we come back and we start looking at this P&L, what we do is we look and we maybe our goal is to hit 13.5% on job labor costs. I'm just making that up, but maybe that was our goal and we hit 14.1%. We didn't hit the mark. And so what we teach business owners to do is each and every month when you're reviewing your financials, have a notepad there, right? And so if I did not hit that mark for that particular month, let's start digging into it. Let's start coming up with a list of 5 reasons why we didn't hit that mark. Share that with our team. Share that with our project manager. Share that with everybody as we're going through this. And it'll be amazing at what we find. And just, I'm blessed. I get to work with a lot of very successful business owners. And the ones that stand apart from the rest, those business owners that absolutely thrive, their team knows what the mark is, knows what that metric is, and where we're at on track year to date, last month, where we're at on hitting that number. So that's incredibly important. The second way that I will look at my financials is I always want to compare what the current period I'm looking at, so whether that was last month or this year to date, and I want to lay over it what we did the previous year. And so every accounting system is a little bit different how we would run this report, but I just basically put a previous year and my percent change when I am going through that. So, previous year, percent change, and I will hit okay. So here's what this story starts to tell me. In my example, and I'm working in the future here, but January through November of 2022, here is my income. January through November of 2021, here's my income, just laying those periods over each other. And then what I do here is I see how much that changed. And where that becomes super important is on that income number. So if we talk to business owners and we say, yeah, income's up 33%, this is where they got that number from. And so what I do is I look at my total income and I determine how much that income has risen or fallen. And in my case here, if you're looking at my screen, my income is up 33.6%. And I file that into my mind when I start to review my financials here, or when I start going through my profit and loss and looking at that. Because what I'm going to do is that is my benchmark. 33.6% now becomes my benchmark because that's my total income. And every single line item on this profit and loss report, what we can easily determine is that if it increased less than 33.6%, in that particular area of our business, we have become more efficient. If that I have a particular line item that increases by more than 33.6%, that's telling me I'm becoming less efficient in that particular area of our business. And again, in the trades, we see this so often, right? Because, we have this constant battle that we're looking at of we need to bring top line dollars in to kind of feed the animal, right? And so sometimes we'll make some concessions on our contracts, our bids, proposals. We'll make some concessions there. But what we need to do is understand, okay, well, what was the effect of that? We took 4% off of that of where we would normally bid it just in order to get that job. And so what we would see maybe there is that, yeah, our revenue was up for the year by 33.6%, but in my hypothetical example, I might have my job materials might be up by 40%. Well, we're kind of going in the wrong direction there is what that's telling me. And so we're just going to measure every line item by the difference in my difference in my total income. And again, that just tells me, am I being more effective or less effective in that particular area that we're looking at? And kind of the beauty of it is, if you've ever had a sales role, we will sometimes get in the mentality that sales will solve all of our problems. Well, in a lot of cases, maybe that we could make an argument for that. And one of the cases that we could is, if I look at my telephone expense, for the most part, Verizon, if we use Verizon or whoever we use, they really don't care if I had $1 of volume or if I had $1 million worth of volume. Their bill is going to be the same to me essentially, right? So you'll typically gain efficiencies on some of those fixed costs that you have inside of your business, but that's just kind of what we're looking at when we're looking at this profit and loss report. Now, another thing that we will see inside the trades is we can split this report one other way. And so if every accounting system is going to call this a little bit different name. But what we can do is if we have different departments or different divisions inside of our company, what we can do is we can start to split those different departments out. So if you're using QuickBooks, about half of you are using QuickBooks, it's something that we call class tracking. And so essentially what happens is every transaction that goes into QuickBooks from a revenue recognition standpoint or a cost standpoint, what we can do is we can assign it a class. We just put a little tag on that transaction. And what that allows me to do is start to look at my business through a different lens. So, I have some sample data here, but potentially we have a commercial division of our business and we have a residential division of our business. And so although the commercial division of our business, I'm giving you some hypothetical examples here, might have more revenue, we can see that the gross profit coming in at 39.3% is significantly less than the gross profit percentage we have coming in on our residential, which is 68%. Again, going through some hypothetical numbers here, but what that allows you to do is take a very non-emotional view of the different divisions inside of your company. And that's great. Our commercial might be 3/4 of our sales, but it's only 10% of our net income in a hypothetical example. Maybe the residential side of our business, is only 1/4 of our sales, but it's 80% of our revenue, whatever that might look like inside of your business organization. By effectively doing class tracking, we can start to split that apart. Now, I did an overly simple example here where we would have like a commercial class or a residential class. Typically, in most trades to where we have, whether we're HVAC or we're electrical contractor, plumbing, typically we would have 4 different classes that we would look at. We would look at a commercial installation, so kind of new commercial work, commercial service, residential installation, residential service. So if service is part of your world as well, you could easily imagine that has a whole different type of cost structure than it does if we're in new construction in a commercial project where we're piping the whole thing in and wiring everything. That has different cost components to it than it would be if we were just servicing something for a commercial customer. And so that's kind of how we're going to start to break that apart, and that's how we're going to start to look at that inside your world. And a lot of companies will also have an overhead category here where they can class transactions directly to their overhead expenses. So that kind of just, I know we only have a little bit of time today, but that's kind of an overview of what we would look at inside of our income statements. The second report that we talked about was that balance sheet report. And so when I look at that balance sheet report, again, 2 things that I'm always going to look at right off the bat when I start looking at that report. The first one is the dates that I want to run this at. A balance sheet works a little bit differently in that it's a snapshot in time. So what you would always want to do when you run your balance sheet report is right after we're done running our income statement, whatever the last day on that income statement was, is where I would want to change the date on this report. So we were looking at everything through November, and I would want to change the end date of this report to the last day that we're looking at on our profit and loss report. And what that does is that allows me to compare kind of apples to apples when we're looking at this. And obviously, I would want to adjust my basis to whatever it is that I'm looking at. Most commonly, you're going to look at these reports on an accrual basis. And so what happens inside of this company here is you can start to see my assets listed out here. And our assets are kind of, you know, from an academic perspective, kind of listed in kind of two different categories. I have current assets. Basically, you know, I have all these different categories of current assets, receivables, cash at the bank, you know, if you had any sort of security deposits or any short-term loans that you made to somebody, those would typically be considered current assets. Rough definition of a current asset is something that you expect to turn over in the next year. Inventory would fall into that as well. So you expect that to always be turning. And then we would have a category here of fixed assets. And those fixed assets are those things that are going to be around longer than a year. Machinery, right? Automobiles, trucks. You know, maybe we have some office and computer equipment that we would have there. And that just comes up with, at this moment in time, our total asset position of the company was here, $543,000 in just my hypothetical example here. And then as I rolled down through this report, by the way, these accounts are fun to talk about, our asset accounts. We start rolling down here. These are not so much fun to talk about. These are our liability accounts. So who do we owe money to? And so, you know, I'm sure we're going to have some payables that we're running through there. Maybe we've accrued some liabilities because we're holding on to some customers' deposits, payroll liabilities. You know, we might have some of that equipment or some vehicles that we financed that would be in there, and I get my total liability position in this hypothetical, inside of this hypothetical company, right? And so essentially the story we're starting to tell with this balance sheet is, okay, well, I have this much assets. How did I get those, right? So I got those by borrowing some money. And the second thing, how I would have got those is by my equity inside this company. You know, have I taken my profits from the company, retained earnings, and I purchased assets with those? And so what we'll start to see under the equity section of our balance sheet is it's starting to break down for me kind of what that looks like. Now, if you go look at your equity section in your own books, it's going to be a little bit more complex than my simple example here, but you know, you're probably going to have shareholders who have taken money out of the company, and that will be reflected there. But you can see what my total equity of this company is. And the beauty of having a piece, an ERP solution, or you know, QuickBooks or whatever we're using to track our financials, is our balance sheets just work, right? So I've got, you know, my total assets will equal my liabilities plus my equity. And so you can see that those two numbers are going to be kind of exactly the same there and allow us, you know, that our balance sheet is in balance. Now, one thing that I'm going to do, because remember, going back to the start of this lesson, I called this my cheerleader report, right? So this is my report that's going to help me kind of unpack, and it's going to give me encouragement. Are we moving in the right direction? And what I will typically do is when I look at this report, I'm just going to create another column right next to this where I'm going to compare the previous year. I might look at that, the amount that's changed. So when I do that, I can start to see here, you know, in my company checking account, gosh, my balance has gone down significantly from last year. But when I kind of start picking this apart a little bit, I can see that my total assets have increased, right? So my receivables have increased dramatically. And so my total assets inside my company has increased. Well, that's moving in the right direction, right? And when I come down here and I start looking at my liabilities here, I can also see that, hey, you know what? My accounts payable is at a lot lower place today, or as at the end of last month, than it was at the end of last month last year. So my payables have gone down. You know, we've made some payments on that loan, and so my liabilities overall in this company has decreased. So I'd say so far when we're looking at this balance sheet, I probably got two things to be thankful for, right? The assets of the company are growing. We've paid down debt. And so what I can see is that my total equity position in this company has grown, right? So that's a really, really good thing, right? So my equity inside this company has grown, and that's how I'm going to start to look at this balance sheet. One pro tip for you. If we're producing financials for the bank or we're producing financials for anybody else, here's the first thing that they're going to look at when they see your financials. They're going to scroll all the way down to the bottom of our balance sheet, and they're going to see a net income number there. And on that profit and loss report we were looking at, they're going to scroll down all the way to the bottom of that profit and loss report, and they're going to see a net income number. Guess what? Those two numbers need to match, right? And oftentimes when we print our financials, those numbers don't necessarily match. And the reason for that is we're looking at a different date range, or we're looking at one on a cash basis, one on an accrual basis. But that's kind of that first check figure that they're going to look at. Okay, am I comparing apples to apples instead of apples to oranges when I'm looking at these reports? So, you know, that's an important note. Just make sure your net income number on these three financials will always match. All right, so we're going to dig into that last report that we look at, and that is going to be our statement of cash flows. Now, this is going to be, this is going to be that one report that is probably the shortest report, but it is the most difficult to probably read and understand. And so again, when I'm looking at these reports, I've got to make sure that I've adjusted my date in such a way that my net income is the exact same figure on those previous two reports. And when we're looking at the statement of cash flows, oftentimes it's going to be your lender or your banking partner that's going to want to see this report most often. And the reason for that is because, yeah, that's great. We made $213,000 in this hypothetical example. But how much cash did that generate when we did that? And so what I can do is I can start to reconcile my income to my actual cash position. And that's where this report becomes a little bit more difficult to read and understand. Because I've got negative and positive numbers here, and they don't always make a whole lot of sense. But essentially what happens here is we have to get ourselves in the mindset of what happened to the cash. So for example, if I look at my accounts receivable here, I've got a negative number by that. It means that I don't have that. Out of this $213,000, I don't have $135,000 of that cash. And the reason I don't have $135,000 of that cash is because it's sitting in my customers' pockets. It's sitting in accounts receivable. So my accounts receivable, even though this has a negative number by it, has grown, right? And so I'm just working my way down here when I look at my payables, for example. In my payables, that's a positive number. So I have to think about what's happened to that cash. Well, I haven't paid that cash out. I'm still holding on to it. That means that my payable balance has grown from this moment in time that we're looking at this report from the previous year. My accounts payable has grown, and so I can kind of see that. And again, it's going to reconcile everything that's affected your cash that does not show up on your income statement. And what that does is that shows me, in this case, that $213,000 worth of income, my net cash increase for this period was $97,000. So this is probably, if I'm looking at this is the first time in this company's financials that I'm starting to get a little bit of a red flag, right? Because we can see that they're growing at a pretty good click from the income statement. Their year-over-year sales growth is pretty good. But if that growth trajectory starts to look like a hockey stick and they start to grow a lot quicker, we can start to see that, yeah, their profitability is looking good, but I might start actually consuming cash inside of my business. There's plenty of businesses who are profitable but consume cash. And at that point, we start to take these financials, and we can go to our lending partner And we can start to tell the story of, hey, you know what? I'm going to need a credit facility or a line of credit, something along those lines, because if this company starts to grow a little bit more rapidly, that's what's going to happen. Is that I'm gonna potentially run out of cash. And so that's kind of what that looks like for me. I know that we're kind of running out of time here. So what I want to do is I want to open this up to our next poll question for everybody. And that's going to give everybody a little bit of time to, use the chat and ask questions. And we have about a 15-minute time frame here that we can go through some individual questions that I can hopefully answer for you. But while we're doing that, we just got a poll question here. How often do you review your financials? Are you looking at those every month, every quarter, at the end of every year? When we're sitting down with the CPA, or we just don't look at them? So feel free to answer that. We're going to give you a few seconds to click on that, and then we'll go into a little bit of a Q&A session if you all would like.
Hey, Jacob, while everybody's responding to the poll or the poll question there, one of the questions I had in it was based on something you said earlier, where not only is it important for the business owner to look at this information and understand it, but you also mentioned about sharing it with their team or their employees. I mean, in your mind, how important is that, I guess, is the first question. And then the second part is, I know there's a lot of business owners that maybe don't want to give too much information to the employees. So how much of that information should they share with their employees?
Right. So, and I'm going back to the most basic level when we talked about, and when I gave that small town example in Iowa, I'm pretty sure that cashier did not know what, they didn't have the full financial picture. But the reason we talk about percentages is because it doesn't necessarily give us dollars, right? So material costs have to be 32%. And if I'm sharing that goal with our team, all I need to do is just share that one metric with them and how we're tracking on that metric. So why I think it's so incredibly important is that we see this a lot inside of companies, is that, yeah, we want to have full reins on this. However, we're expecting members of our leadership team, our project managers, we're expecting all these people to pull the rope in one direction. We're not giving them the compass of what direction we expect that rope to be pulled in. And so, probably a bad analogy, but if we just use those metrics of, hey, payroll costs have to be this, labor costs have to be this. Here's what happened last month. We missed it by 2 percentage points. Your team is going to have better ideas for you of why you missed it than you will ever have, right? And so they can help you start to break that down and understand the corrective actions that need to happen inside of your four walls. So, to kind of answer your question, it can be uncomfortable and it can go against the culture in some organizations, but we highly recommend sharing those metrics.
Great.
Not the dollar amounts, but at least the metrics of
Sure.
the percentages.
I'm going to go ahead and share the results here. And I guess this is good news that we had 70% of the participants here review their financials on a monthly basis, a few on a quarterly, and some only at the end of the year. So definitely the right trend that we want to see there. Absolutely.
That's exciting. So obviously we can't adjust, we can't track what we're not measuring as close to real time as possible.
Sure. Again, I would like to welcome anybody to ask any questions either in the chat or with the Q&A feature within Zoom. Jake, one other question I have, kind of building on the last question I asked there, was sharing this information with your employees or your team members. Really looking at something like that P&L statement, we could break that down to the individual project level, to where that project manager can then make decisions and be able to track their profitability on that project from a month-to-month basis.
Oh, absolutely. Absolutely. And so, yeah, and we didn't get, once we start dialing this in and we start dialing it down, obviously that's the ultimate goal of anybody who's in a trade or anything like that, is for us to be able to do project costing in order to understand our profitability on each of those. And, probably one of the best examples I have of that would be, a construction company that I've had the pleasure of working with is their CFO, which just happens to be the owner's son. He kind of really took that project accounting piece to the next level and really dug into it. And the changes and the effect that that's had on their business has been nothing short of astonishing in terms of their profitability. It's amazing, from as he describes it, now that he has kind of that financial literacy, not only on the overall company financials, but on each individual job, those financials, how he described it to me, and he's proven it time and time again that's the case. He says, I feel like I'm a piano tuner who carries around like a tuning fork. And if I think that I need business 4 months down the road to fill my pipeline and I want to adjust margins, we now have such high control of our business and what that looks like, is I can predict what that will do to my financials and whether or not we get more aggressive on that bid or anything like that. And so it's really cool once you start to be able to dive into this and just grow in your financial literacy.
Great. Got a couple questions that are coming in here through the Q&A, and a couple of them here are kind of along the same line, so I'm going to present them to you together and let you handle that. But the first one is, any tips for driving deeper understanding of metric structures that contribute to key financials? And then kind of the second part would be, is where can we find more detailed and in-depth training on these financial statements, preferably in QuickBooks? And I guess I'll answer part of that. Everybody that was in attendance on today's webinar will be receiving an email from us, hopefully by the end of the week, not only with a link to the recording of this webinar, but also we will include Jacob's contact information. So if you have specific questions, you can reach out to him and get a little bit better understanding of how ARC Financial can help your organization. But Jacob, is there anything that you can touch on as far as tips of driving a deeper understanding on these metric structures that you described?
Yeah. And so I would usually say that, if we're just going to start to set the bar, what should my metrics in my business look like? The fortunate thing is that, kind of in the scope of kind of the construction industry or trades, is that our industry associations have done an amazing job of letting us know what this looks like, what this should look like, what good looks like inside of your business. The other thing is that we also have access to a resource that may be not available to the general public. And so if you have specific questions, again, you'll have our information. Is each year what happens is individuals in the mergers and acquisition industry have the opportunity to look at businesses of every industry and every size inside of those industries as they're putting deals together for a merger or an acquisition. And there's a resource that's available to us is that we look at those companies who have been put on the market who would probably have solid financials, and all the names are redacted, but we know the industry, the size, and we start to develop some benchmarks based upon, hey, we have these 100 we have these 100 let's just use a plumbing contractors. We have 100 companies that we've looked at that are running between $2 and $10 million, here's what their metrics look like. And so we can share that, one-on-one. I'd be happy to dive in and hear more about the size of your organization, and then we can help you with maybe some benchmarks there.
Sounds great. We got a couple more questions here too, if you have time for those. I know we have about 5 minutes left here, and we want to respect everybody's time. One of the questions here is, what is the best way to forecast price and change orders on a project? So I'm not sure if we have all the information we need to answer that question. I don't know if it's maybe forecasting profitability of the project, because really forecasting price and the change orders would be more of an estimating component of the overall project process. So I don't know if maybe if we added profitability in there, how we could maybe answer it looking at the project and any change orders with forecasting profitability.
Yeah, there are some tools, like when we look at QuickBooks, if you're using QuickBooks Desktop, there's some tools inside that software that kind of allow us to do that. One thing that we've experienced in the last just year and a half, a lot of companies for their backbone or for their GL are moving to QuickBooks Online. In QuickBooks Online, if we wouldn't even consider it 2 years ago that it might be an option for somebody in the trades. Today, they have some really cool tools that will help us real time understand whether we're on track with a project or not. And so those are great tools if somebody wants, is interested in learning more about that. We could be a resource for you, or YouTube. There's a lot of great videos out there on how to start implementing those tools, because it's changing the dynamic of how we can look at our GL on a customer basis.
Great. And I got another one here is, we don't use the cash flow statement, so trying to understand it, comparing years, what red flags am I looking for?
Yeah, so what we're looking for in that cash flow statement is, essentially what I'm looking at is, we spend a lot of our time focused on, are we profitable? Right? So that's our goal in our business, right? Is to be profitable. But what we also have to understand is, are we gaining throughput inside of our business? And how I'll define that real quickly is that customer's transaction turns into cash. We call that throughput. So it's great we do all this work, but when does it turn into cash for us? And so that statement of cash flows helps us understand that. So when you start to see a huge disparity between your profit and how little cash that profit is generating, that's what the red flag is for us. That, hey, I'm not generating a significant amount of cash because maybe I'm retiring debt too quickly, or maybe I've extended my terms too far with my customers. And so, or just another thing that can happen in an organization, maybe we're taking distributions out of the company at too rapid of a rate. So we're not growing our cash to the level that it needs to be.
Great, thank you. That was all the questions that we've had presented to us at this point. If anybody else has additional questions, again, please add those to the Q&A or to the chat. We'll wait just another moment here to see if we have any additional questions that come in. Again, I will send out an email, or we'll be sending out an email that has a link to the recording, as well as Jacob's contact information. If you would like to get in contact with us at Firestone Consulting Group, you can see our web address there on the website and our phone number. Again, I want to thank Jacob for taking the time out of his day to join me as a guest on our webinar this month. Please tune in next month. Again, the last Wednesday of each month, we will do our webinar. So please make sure that you mark that on your calendar, and we will send out more information as it becomes available.